today we planned inter-unit elimination of profit in inventory. IPI we call it. So whenever we call BC word IPI, so it's because inter-unit elimination of profit in inventory. This, to understand this particular concept, how the elimination happens, to understand this concept, the prerequisite, you should have good understanding of consolidation processes, elimination processes. You should have good experience, actually at least 1 or 2 projects. If you complete in consolidation, you can easily understand. Another thing is I'm implementing this one in the group reporting, so you should have S/4HANA group reporting product knowledge. So there we are going to use reclassification methods in group reporting. We are going to use reclassification methods to configure this particular inter-unit elimination of profit in inventory. So you should have knowledge in this particular reclassification methods, then only you can understand. So some concepts here, whatever concepts are there, if you want to give demo to the customer, so whatever I prepared now, you can use this same concept as a demo to the customer. In this particular demo, profit on inventory elimination, so the concept is straight. When goods are sold within the group and are still in the inventory, the margin must be eliminated, right? When goods are sold within the group and are still in the inventory, the margin must be eliminated. How can I do this? This is a new concept SAP introduced in 2020. So from 2020, S/4HANA 2020, this concept is available. But in 2020, we need to configure everything. We need to configure all these accounts, whatever I have written here. We need to configure the reclassification methods. Then we need to assign to the task, and we need to execute. But in S/4HANA 2021, whatever server we are using now, in S/4HANA 2021, they already added all the configuration as part of 1SG. So we installed a 1SG. In the 1SG, with the 1SG content, you can just give some transaction data, test data, and you can execute this particular inter-unit elimination of profit in inventory. So let's understand what is this particular concept, how it works in group reporting.
Hi Kiran, can we say margin as a markup also, because some clients say markup, right?
Yeah, markup only. Both are same. Correct. So I have selling unit, buying unit. So for example, Canada is the selling unit, US is the buying unit. Both are in one group. So these two are in one group, which is my America group. In America group, I have US and Canada. Now Canada is selling some goods to US. So in Canada books, they booked sales, they booked cost of sale, yeah, and the margin is 20%. So the sales value is 10,000. So the inventory value in US will be 10,000 booked. Now when I am consolidating at America group level, I need some elimination at group. What is that elimination I need? My Canada, whatever markup or whatever margin they said like 20% margin. That amount, whatever is there, that should be reduced from my inventory, US inventory. It should be reduced or decreased from the inventory, eliminated from the inventory. So the right word is eliminated from the inventory. And also net income of the selling unit, to be adjusted, right? How the calculation, so my inventory value is 10,000, that 10,000 multiplied by the In the selling unit, they are maintaining the markup or margin, 20%, right? So the 10,000 multiplied by this 20%, which is whatever, 2,000 is my elimination from the inventory and adjusted from the net income. So how to do this one? Where we have to maintain this 20%, how this 20% should be given is what we have to understand. So what SAP did here, they come up with additional characteristics. So there is a concept called additional characteristic in group reporting, you know, right? So when you want consolidation with additional fields, you can enable the master data for those additional fields. That's what we understood in group reporting. So here, additional characteristics, what you need, material or material group, based on what you want to calculate this margin. So you can enable material for the master data. Yeah. So the data for this required data, we can, I have prepared some sample data. I will show you the sample data. When you provide that particular sample data, what are the entries system is going to post based on the standard content, I'm going to explain. So the FS items I'm going to use, these are the FS items I'm going to use. So basically this 131200, which is my one means my asset account, right? My asset account starts with 1. So 131200, which is my merchandise account, asset account, inventory account, you can say. So 412100, which is kind of clearing account changes in inventory account. These two, 41200D, which is clearing account gross margin P&L, 13100D, which is clearing account gross margin balance sheet. So 1, it is starting with 1, it is starting with 4. Now the 20%, the markup rate is maintained against this particular IPI rate. So IPI rate is I created this one as a FS item, and it can store quantity. So the breakdown category we have to create accordingly.
So this is not a standard.
So with the 2021 it is available. Yes, your point is correct. 2021 it is available. They delivered IPI underscore rate. Okay. If you are using 2020, you have to create. Yeah, how to create that one? I will explain you when we after this recording. I will explain the configuration. Then I will tell you how to create that breakdown category, how to create this particular FS item in the FS item list. And also there is one FS item which is stat account, IPI gross value M market. So IPI GVM, IPI internal inventory gross value merchandise, right? So this account I need, this is not coming from your ACDOC table or any other non-SAP data. So this is manually maintained. The value of this particular FS item will be maintained manually, because 131200 or 412100, whatever these accounts, we need to identify what amount for that particular material, right? So you are calculating, right, markup for a particular value, right? So for example, Canada sold to US. So this 10,000, whatever the value is there, that should be identified against US. In Canada books, it should be identified against US, and that I will put it in this particular financial statement item. So the some sample data I prepared here. So the highlights, what the SAP introduced here, the highlights I'm just written here. I just wrote here. The reclassification methods, they added one good functionality in the reclassification method, one checkbox they added. Read from partner unit. The checkbox is read from the partner unit. So read percentage from the partner unit, right? See why this is required. When Canada selling to the US, the amount which I need to I need to eliminate the margin I need to eliminate from this particular inventory, which is in US books. But the percentage is maintained by the Canada selling unit. Markup percentage maintained by the selling unit. That's why we need to take the inventory value from the US, but the percentage markup we have to read from the partner unit. That's why. Read percentage from the partner unit. Now, partner unit in the sense that may be partner unit, partner profit center, or partner segment. All these options they have given. Define characteristics to match trigger and percentage. See, there might be a scenario where I have different materials. It is not necessary that all the materials or all the products I am using same markup. I have two different products or two different materials I sold to US. So A, B, for example, A I want markup as 10%, B I want markup as 15%. So that's where additional characteristics come into picture when you are providing the data. So I added one more column here, material in the file. If you see, this is the transaction data I'm going to maintain in the system. So these 4 records I'm loading. So first thing I have to mention in the Canada books, Canada is my selling unit, US is my buying unit. So seller, buyer, US is buyer. What is the margin here? 20%. The 20% I mentioned in the quantity in base unit, 20%. And what is the material? P68110. This is the material. You have to maintain this material master data in group reporting, in the consolidation master data fields. And this 20 is percentage. PRC means percentage. So here in the first one, IPI rate, this is the FS item we created. In that I am telling 20% is the markup for this particular material. Second thing, I have 131200, which is my mercantile account. So this line, yeah, which is my mercantile FS item. In this, here I showed 10,000. There might be some 40-50,000 will be there in this account. Yeah. So in this 50,000 is there. But in this particular account, I don't have any partner unit. So this is my US, who is buyer. In my buyer books, in the inventory, I have this inventory P68180, 50,000, right? But how much is from Canada? That details not there. So that details I'm going to maintain against this particular IPI GV_M. So we need to maintain one stat account. This is not part of your balance sheet or income statement. For our calculation, we need to understand what is the intercompany or inter-unit inventory value against that partner unit. That's why this in the buyer books against the seller, yeah, we maintain that much value, 10,000. But here test date I have given 10,000, but this particular 1312100 can have third party and intercompany together, whatever amount is there. And some cash amount, so 10,000.
So right now, separate GL account for intercompany and third party. So this step may not require, right?
Not required. Yes. If you have separate account, not at all required. So this will be the other account will be your trigger. So currently, what I did, because this account is having third party and intercompany, what I did, I put my intercompany amount here in this particular account, and I use this particular account for my trigger in reclassification method. For you, anyway, that is separate account, you can use that one as a trigger.
Okay. And also the markup normally will be maintained from the ST side in the condition report. So this is going to be additional maintenance from the group reporting to match that markup value, right?
Exactly, correct. So here, what are the entries system is going to pass? Yeah. Step 1. We are going to create 3 sequences. Yeah, I will explain those 3 sequences in the configuration time. So sequence 10, sequence 20, sequence 30. 3 sequences I am going to create, right? With these 3 sequences, why with these 3 sequences needed, I will explain now. That's what the elimination post. Yeah. First sequence. Yeah. Buyer side. So first sequence we have to create to post the elimination entry in the buyer side. So the full entry will be the buyer side. Who is the buyer? US. See, when I say buyer, buyer is US, seller is Canada. So buyer side I am talking about. So first elimination happens in the buyer side. So if you want the clarity of what accounts these are, so we can take this one, this data here. Let's put this data here. Yeah. So first, whatever amount is there in my mercantile account in the buyer books, yeah, that will be eliminated with the amount. What is the amount? That inventory value is 10,000 multiplied by 20%. This margin rate, right? That much amount eliminated from my buyer books from 131100. So when I posted, when I uploaded the uploaded data is a debit value, that is positive value. From there I am reducing 2000. So this is my mercantile account. So this 412100, which is my changes in inventory, which is my P&L account, right? When any transaction posted to P&L, we already calculated the net income, right? We already calculated the net income. Now we are going to change my net. We are going to change the net income of my buyer US books. So automatically system will post earnings effect, right? So what happens, because my changes in inventory posted, yeah, this is my P&L, system automatically debits my balance sheet net income account, credits my P&L net income account, right? So this is net income balance sheet. This is net income P&L. This we understood earlier when we were discussing manual journal entries. I explained. So when one leg, after calculating the net income, when you are posting any adjustment, if one leg is in P&L, other leg is in balance sheet, right? System automatically going to adjust your net income balance sheet and net income P&L. So there is a configuration in SPRO that will be triggered automatically when calculated net income is affected. Now here this is okay, credit this, so we eliminated this whatever amount 2000, whatever is calculated amount 20%, but net income should not be adjusted, correct? Because it's buyer books. Net income in selling unit we have to adjust. Net income should be adjusted in the selling unit. Inventory should be adjusted in the buyer unit. So that's why what we do in the sequence to step 2 we will configure. In the step 2 what we will do, we will reverse the elimination in the net income of the buyer. So whatever is posted here, this entry we will reverse, and we will create 2 clearing items in the buyer books only. So these amounts, whatever 2000 amount is there, whatever changes in inventory 2000 amount is there, that we will post to the clearing accounts. One is in P&L, one is in balance sheet, and we will reverse this particular entry. So what happens? Same thing here. I have clearing account gross margin PL, clearing account gross margin balance sheet. So these 2 accounts you know. Right. So now what happened? My net income reversed the earnings effect. With the second sequence, we reverse the net income and the amounts are stored in the clearing account. Now, third one, right? Third sequence we will create. Why we create third sequence? To adjust the net income of my seller unit. Who is my seller unit? Canada. So what it will do, whatever amount, that 2000, so the net income adjustment 2000 will be posted to the clearing account P&L balance sheet and also clearing account P&L. So if you see with the sequence 20 and sequence 30, my these 13110D, 41200D, all these one leg will be posted from the US, one leg will be posted to the Canada. At group level, both are matched, right? And debit to my balance sheet net income, credit to my P&L net income, so that my P&L net income and net income balance sheet are adjusted with that markup 2000. So this is my net income balance sheet. So if you observe at the end of the entries, yeah, so these two gone, this done, right? And this net income is reversed, whatever in the buyer unit. So my mercantile account in the buyer is adjusted with 2000 and my net income in the seller unit adjusted with 2000. So for our more explanation, so most of you might have understood based on this explanation whatever I have given here. So some more explanation, I try to explain some more based on the, suppose we people understand if these are in debit credit in accounts, right? So let's understand this one. Initially, yeah, I loaded some data, right? 131200, we uploaded data. How much we uploaded? 10,000 I uploaded, right? So this 10,000 same I also put in IPI GVM, which is my so this is my mercantile account. This is duplicate mercantile account, stat account. In that also, I put this 10,000 amount against the Canada, because in 131200 I cannot track my partner. So I created this particular FS item where I can put against the Canada. How much? 10,000. So in the step 1, what happened? That in this 10,000, right? So 2,000 eliminated. 2,000 eliminated, which is my markup. How system understood the markup? The markup is given from the selling unit, because SAP introduced a new functionality where it can read percentage from the partner based on this option. So here this 10,000 reduced in the step 1. So the first entry, one leg in mercantile account, other leg in 412100, 2000. So here it is credited, here debited. Because of this step 1 entry, one more entry passed because of the earnings effect. That is here 317000, which is my net income balance sheet, debited, and my 799000 account credited. So now in the second sequence, what I did, whatever step 1 posted in the step 2, in the sequence 20, I reversed. See here, step 2. So these two nullified, reversed. What are the, so one leg is posted to this 317000, other leg where it's posted, it's posted to the clearing accounts. Clearing balance sheet gross margin, clearing account gross margin balance sheet, and P&L. So here these two are there, 131100D, 41200D, based on the step 2, 2000 debited here, credited here. Now in the sequence 30. And what I mean, in the next sequence, next step, what I did, whatever these clearing accounts are there in the step 3 against the seller, I reverse these entries. So 2000 minus credit he posted here. So I showed separately because I can give only one consolidation unit here. So 131100D here, step 2 2000 debited. So in the next sequence, that will be credited. Same way, in the sequence 2 41200D debited, and in the step 3 sequence 30 it will be credited here. I mean, step 2 credited, step 3 debited. And from the seller books, so C Canada is my seller. In the seller books, right, you see my 2000 is reduced from the net income balance sheet, 2000 is reduced from the P&L net income. Right. So this, when you configure in the system, so in the consolidation monitor, you have a task to execute this IPI. So here when you execute, so the document type, it is going to take 2Z. 2Z is the document type. And posting level is connected to 20 only. Posting level is 20 only. So the task number is 2105, I think 2105 something. Yeah, we can check it in the system. So right click here, test it. So here document type 2Z it has taken. So 2015, the task IC elimination inventory. So as I said, like this 10,000 is my triggering amount. You can see here. IPI internal, so here. So US and Canada sequence, first sequence, right? These entries are first sequence. The triggering amount is 10,000, which you posted in the IPI underscore GV underscore M. From there, 20% is calculated, and net income earnings effect plus changes in inventory, merchandise, those entries posted. Next sequence, what happened? Same amount, 10,000 has been taken, USD. US to Canada, buyer books only. Whatever here it's posted, so here positive 2000, here negative 2000. That earnings effect reversed, and the amounts are posted to the clearing account. And third sequence, when it is 30, same 10,000 has been taken, right? But these amounts are posted in the Canada books, seller books. From the seller, the net income is reduced, 2000 minus 2000 at group level, and whatever, see here, whatever clearing accounts are there, 41200D, 1300D, the other leg will be posted from this sequence 30. This way you can eliminate profit in inventory. Yeah, any questions?
Kiran, profit in inventory only when the inventory is in the buyer side still.
Correct.
So what happens when the same inventory is sold to the third party customer from the buyer side?
That's okay. That is realized. Yeah.
Okay, that's a realized. Okay, so this entry will not be reversed when the actual stock is sold to customer.
Yep. whatever is unsold, so that that we have to do. Yeah. Yeah, someone is asking some question.
Kiran Prasad.
Yes.
So basically, when we look from the consolidation perspective, what finally the net impact of the entry would be, stock has been reduced, and to the extent of that profit which has already
Exactly.
shown in the seller, that would be reduced, right?
Exactly, correct.
Okay.
Whatever intercompany profit he got, that will be reduced for the inventory which was unsold.
So reduce it from the both sides. One side the net income is reduced, and other side is inventory value of that extent is reduced.
Exactly, correct. So now the configuration, I will stop the recording. Yeah. So we'll go through the configuration after this.